All right, welcome everyone to Value Investing Live. I'm pleased to welcome our guests this week, and that is guests plural, Javier Saenz and Chris Mittleman. Javier has more than 20 years of experience in manager selection and joined Azvalor in 2018 to lead Azvalor Managers. Chris serves as the Chief Investment Officer for Mittleman Investment Management LLC and directs investment policy, research, and portfolio management. As always, for those of you out in the audience, do please feel free to post your questions and comments in the live chat throughout the presentation, but we will be holding those until we get to the end of each section. Both Javier and Chris will be doing their own little sections today, so do please feel free to post a couple questions for Javier on the Azvalor Managers section at the beginning here. We'll answer one or two questions there before we transfer over to Chris in his section of the presentation. Then we'll take some questions for him after that. As always, though, please let us know where you are coming from out there in the live chat. Does look like we have one hi from Austria already, so pleased to have you join us today. But without anything further from me, I'll go ahead and hand things over to Javier and we can jump into things.
Okay, thanks so much for your introduction, Graham, and thanks, Guru Focus, for having me. I believe we are the first international investment firm that features on your online event, so we feel tremendously honored to be invited today to such a prestigious platform like this. Apologies in advance for my strong Spanish accent. I'll try to make myself as clear as possible during the presentation, which will be structured in three parts. Firstly, I'll go through Azvalor as a firm in terms of history, background, and main features of our corporate culture and process. Secondly, I'll focus on Azvalor Managers strategy, covering, well, basically what it is and how we build the portfolio. And after that, we will have an interview with Chris Mittleman from Mittleman Brothers, who is one of the managers we invest with on Azvalor Managers. So, who are we? Azvalor is an asset management company founded in 2015, independent, fully employee-owned firm with a strong skin in the game culture. We invest our personal financial assets in our own funds as a way to be fully aligned with our co-investors. We truly believe the one and only way of being good stewards of capital is to invest alongside our co-investors with the same exact terms. And in that sense, we are not an asset gathering firm, but more investment centric, focus on investments and on delivering long-term returns. And accordingly, we strive to ensure that our investors understand our investment process and share our long-term investment horizon. In terms of the firm setup, we have offices in Madrid and London. We currently run $1.5 billion and have around 35 employees in total. We've publicly committed to a maximum AUM limit of 2.5 billion on our core direct equity investment strategies. So we have one only investment team and one investment process. In terms of our investment principles, we are specialized in long-only fundamental bottom-up stock picking with a deep research mindset, a strong focus on valuation, and a willingness to be contrarian if need be. We invest in businesses we can understand, looking at them if we were buying the entire company. We don't pay attention whatsoever to benchmarks, and we believe volatility and risk are two very different things. So we will manage risk through a thorough understanding of our invested companies in order to try and avoid permanent losses of capital. In terms of the executive team at the company, we have 4 founding partners you can see on the slide, 3 of which worked together previously at another investment boutique called Bestinver Asset Management, where they deliver excellent long-term returns prior to founding Azvalor in 2015, as I mentioned. Our investment heads, Alvaro, Guzman and Fernando Bernad, worked together actually in the late 90s at a value investment firm based in Frankfurt. Later, they rejoined forces at Bestinver in 03 and 07, respectively, and hence have worked together for quite some time now. And lastly, I'll mention that Alvaro and Fernando, our co-CIOs, have been featured in a book called The Value Investors by Ronald Chan, alongside some really legendary investors like Howard Marks, Walter Schloss, Irving Kang, Jean-Marie Beijart, and many others. A very interesting book that I strongly recommend. Alvaro and Fernando run 2 main strategies, one that invests in Iberian equities, so Spain and Portugal, and the other one more international in nature, but both applying the same exact investment process. But besides those two strategies, and moving on to the second part of my presentation, we also manage a strategy called Azvalor Managers. So basically, what is Azvalor Managers? What kind of managers are we looking for to invest here? We are looking for investment boutiques with stable and vocational close-knit investment teams, firms that are specialized in a single strategy, a single investment process, managers that should have a strong stewardship mindset and substantial skin in the game through personal investments in the funds they run, investment processes that are focused on long-term stock picking, concentrated and constrained portfolios, firms that manage a reasonable level of assets under management and are capacity mindful, managers that have lengthy experience managing money and that have in place robust operational setups. So if you think about it, basically managers like us, like Azvalor, not necessarily in terms of the same exact investment process, but like-minded around the corporate culture and overarching investment principles. Trying to pass to the next slide, that it's not working. Bear with me for a moment. Well, while it's running properly, basically our process to select managers, how we select them, right? So our idea generation on the manager selection side is purely qualitative. So in order to find managers, we conduct a sort of scuttlebutt approach applied to manager selection. So we talk to private and professional investors worldwide through an extensive global contact network built over 2 decades. We read all kinds of articles from managers, interviews, quarterly letters. We attend conferences, we read investment books and all kinds of investment literature. And of course, we ask managers about other managers that they like, managers that they would put their money to work if they were not investing themselves. So we kind of scout the global market to generate ideas, avoiding any kind of quantitative approach or inputs based on past performance. After that, we conduct extensive research on the managers we're interested in, including all kinds of inputs and analysis, both tangible and intangible. And at some point in the process where we've built a reasonable level of conviction, our co-CIOs would jump into the process to do what we call the last mile analysis, i.e. talk to the manager directly. So kind of portfolio manager to portfolio manager conversation to discuss investment cases and challenge some of the manager's investment thesis, hence elevating the whole debate to a whole new level, I would say, whereby we believe we can potentially identify weaknesses or inconsistencies on a given manager's process. We strongly believe that this process kind of increase substantially the odds of making eventually a good manager selection. And the ultimate question we make to ourselves is the following: would we invest our entire financial capital on this manager? And we only go ahead, obviously, if the answer is 100% yes. So as you can see, our research process is very deep, very intensive. And our approach is to partner with managers for the very long term. And in that sense, we don't make decisions or change our view due to a bad performance stint. We know all active managers in the world, and I mean all, have bouts of poor performance, sometimes severe underperformance, and sometimes for lengthy time periods. It's just, in our view, part of the game, and one needs to evaluate the reasons for that performance and whether it's driven by a permanent loss of capital or it's just the market being out of favor for that particular strategy or investment style. Same thing in periods of very strong performance. I mean, one needs to try and separate skill from luck. I would recommend on this paper from a company called Alpha Architect. I think the paper is called something like "Even God Would Get Fired as an Active Investor," because on this front, our approach is to be very close to the managers in order to go beyond performance and to focus on the portfolio, on the process, on the team, on the corporate culture. And as long as we have conviction on those aspects, we will stick to our guns. Now it's working. Sorry for that. So through this process that I just described, we've selected 4 managers, same 4 since we started in 2018. I won't go in detail into each of them, but we'll give a quick overview before we dive into Chris Mittleman and his process. And in no particular order, firstly, Donald Smith and Company. It's a firm founded in the early 80s by Donald Smith, a former student of the father of value investing, Benjamin Graham. Richard Greenberg leads the firm and investment team here. He managed portfolios alongside Donald for nearly 4 decades, up until Donald's passing a couple of years back. The investment team is rounded out by 4 other people besides Richard, including John Hartzell, who is co-CIO. John joined the firm in 2003 and has nearly 25 years of experience. And the portfolio they run for a strategy consists of US small and micro cap companies selected through in-depth qualitative research with a strong willingness to look into out-of-favor areas of the market that are sometimes extremely depressed in terms of market valuations. Secondly, Morus Capital Management, firm led by Amit Wadhwani, who worked for 2 decades alongside legendary investor Marty Whitman, that probably most of the audience know, at the US investment firm Third Avenue, where he was responsible for the international stock portfolios. Morus was founded in 2015 by Amit, along with 3 former colleagues from Third Avenue, Michael Campagna, John Mauro, and Benjamin Belfer. Their portfolio invests in companies of any size, sector, region, total flexibility, including emerging markets to some extent, and with a strong focus on valuation and margin of safety. Amit's team pursue an asset-based investment approach, what they call here and now analysis, looking basically for companies trading at a discount or deep discount to what their net assets are worth today. Thirdly, Gehring and Rosenwach, a firm founded in 2015 as well, coincidentally, by Lee Gehring and Adam Rosenwach, specializing in the natural resources equity sector. Lee actually started running funds in this segment back in 1991, first at Prudential Jenison and from 2005 at Chilton, where he started working with Adam actually in 2007. And together they manage one of the world's most successful funds in this area. They are one of, if not the most experienced investment teams globally in the natural resources equity sector. And Adam and Lee produce excellent top-down research on this segment that, interestingly, they make publicly available. They are not afraid of going against, consensus views and as and when needed. And I strongly recommend the quarterly letters. They are really deep, and they usually go through supply and demand dynamics on a variety of commodities. And last but certainly not least, Mittleman Brothers. We are lucky enough to have Chris Mittleman here with us today, so our audience will hear directly from him. But as a way of introduction, Chris is the firm's CIO at the firm, has 30 years of experience. Chris founded the firm with his 2 brothers in 2002 and follows a private equity approach applied to the public market universe, performing a very exhaustive research process on each company. His portfolio, as he will explain, is concentrated in about 10, 15, 20 stocks of any region, sector, size, with a bias historically towards small cap companies. And historically, he's been investing significantly in international names alongside US companies as well. So before we move on to Chris, I think, Graham, we are opening up the floor for any question related to either Azvalor or Azvalor Managers that I'll be happily answering.
Absolutely. And we do have a couple questions here. Looks like we do have a nice international audience joining us today. So welcome to all of you. We do really appreciate you being here with us. Looks like we'll go ahead and jump into question down here. Azvalor mainly invests in stocks in the actual financial markets. Is there any consideration there for startup companies, IPO, things like that? Considering the market is so high at this point in time, how would you say you manage risk as far as approaching these?
Yeah, in terms of how we manage risk, which I think this comment would probably apply to all 4 managers that we invest in on Azvalor Managers as well. We, as I mentioned earlier, we don't consider volatility as a good measure of risk, and we try and understand our investments inside out and try to understand what risks the companies are exposed to. So, in this sense, I think that at this point there is, parts of the market that are to us extremely expensive in any way you may want to look at them. There are other areas where we are definitely finding value. We are totally agnostic in terms of the areas where we can look. We can basically invest anywhere, and that gives us flexibility to try and exploit our kind of deep research on companies, trying to be flexible and go to areas that are probably not the most comfortable to invest in, but where we think we can find the best opportunities.
Absolutely. And we'll go ahead, we'll jump into one more here, and then we can go ahead and transition over to Chris. As far as these businesses, and obviously Azvalor Managers is relatively fresh, but how often are you reevaluating? Is it a monthly basis? Do you consider bringing in new managers to the teams, things like that?
Yeah, I mean, in terms of monitoring the managers, it's, I think, 24/7 job. I mean, we try and be on top of everything that's going on, to know the portfolio to as much extent as we can. On a kind of more formal basis, we talk to the managers on a quarterly basis, but in between, there are obviously informal interactions, and we've kind of tried to, as we consider our managers like really long-term partners in nature, we've tried to build kind of a good relationship with them and have an open discussion at any point on basically anything related to investments and to the portfolios.
Absolutely. Alrighty. Well, as I mentioned prior to us going live, we do have plenty of questions lined up here, but we do want to leave plenty of time for Chris to go ahead and go through his section. We can revisit some of these at the end if we do have time as well.
Okay, brilliant. I'm happy to answer any questions later if needed, or obviously after today's event, people can contact us and we will be happy answering. So, well, I already introduced Chris, so I'll just kick off and go ahead with a few questions to try and structure a little bit the conversation. Maybe, Chris, we can start with a little bit of your background. How you became interested in investments in the first place. It's been 30 years now, so pretty long time, and I guess things evolve. But what attracted you to this type of job?
Sure. Thank you, Javier. I wanted just to say sincerely thank you for picking us for your fund. To be one of 4 selected for this managers fund is something that is a huge honor for us. For me personally, I say that sincerely because I had followed the success of Azvalor's founders at Bestinver, which was anyone who's not familiar should look up the track record during the time that they were there. It's outstanding. One of the best, I think, in Europe, in maybe the history of value investing, at Azvalor's own record. And when somebody who knows what they're doing decides that they would invest with you, it's a huge honor. And I know the other managers a bit, having not personally, but having seen them in action and being aware of who they are. And I just think it's a great thing for a small firm like ours to be included in that company. So I'm very proud to be a part of it, and I wouldn't have done it otherwise. We normally eschew the concept of participating in fund of funds type structures, and this is not really that. It's very much different than that, I believe. So I just wanted to put that out there in front. And my beginnings are probably a little bit different than the average manager. I think most managers get involved, in an analyst training program. They work up to portfolio manager, a more traditional entry. I was a stockbroker in 1990 at Shearson Lehman Hutton, and I was a really bad stockbroker. And I never got much better at the sales aspect of it, which may be partly why Mittleman Brothers itself is not a huge firm AUM wise. But I did find an affinity for the analytical side of investing, and I just went about in 1990 thinking of trying to figure out how this works, who does it well, and how do they do it. And I got all the books that you might buy back then, the Money Masters, the New Money Masters by John Train, the various popular bits of research that were floating around back then, and it became very apparent to me in my early 20s that value investing seemed to be the more persistent of all the various strategies that one might employ in terms of its tendency to outperform. And it made sense why that would be. It's you're presuming less when you're investing with a value bent. You are not assuming as much about what the growth rate's going to be going forward. And if you can find relatively simple to understand businesses trading at valuations that seem at too great a disparity between what the private market value should be, then it would seem logical to assume that those types of situations would lead to better outcomes. So it was one of those things, like Buffett talks about, it's an inoculation. It either takes or doesn't take. And it took with me very quickly that having a value orientation just made sense. The global side of it was more serendipitous. I was in Shearson Lehman Hutton's international sales division, and I was surrounded by international research. And it just gave me a sense of the broader picture and I guess an affinity for that. So the value and global came together for me in that first year. And then the concentration also came about in that first year, where I basically looked at, of all the value managers that I could find at that time, and there were a handful, more than 20, the guys who seemed to be doing the best were the ones who had concentrated more than those who were more diversified. So there were guys like Tweedy Brown that was very influential in my thinking, that had done very, very well for decades with a much more diversified portfolio than someone like a Warren Buffett or a Richard Rainwater, or somebody who was a lot more concentrated. And the more concentrated investors seem to have a higher CAGR. Being one person, one stockbroker, not having a team or a staff, I also felt that being more concentrated would be more logical for my more limited capacity as one person. So I set about making portfolios of 10 to 20 stocks back then. That was the concentration level I felt comfortable with. I would fax these portfolios out to various prospects, and very few of them responded favorably. These were, deeply undervalued names like a steel scrap recycler in a time when biotech was hot in the early 90s, just things that no one wanted. But it worked, and it worked out, not always, not every year, but it worked most of the time. And what that built was a loyal base of clients that became the foundation of Mittleman Brothers years later. And many of those clients we still have. So there's people with me today, here we are in 2021, that were with me in 1991. And I think I'm very proud about that relationship that we have. So we've got a very high client retention ratio, and I think part of that is the trust and confidence that we've built up over decades with these people and their life savings. So, but it is a volatile strategy. So when you concentrate, you have to be prepared for these swings. It's something that the guys at Azvalor know very well, but not everybody finds it comfortable. So you really have to be prepared for big moves up and down, and sometimes the moves down can be really harrowing, and we've been through that a few times. But that's part of the game. That's part of the business, and we've learned to, rather than be, I guess, frightened or put into the fetal position when things get bad, we look at those opportunities as a time to become more aggressive and to really light up and to become more animated in our views, and to try to get people to recognize what those moments in history tend to be. And so when you look at the way that we've performed over the years, we tend to do better coming out of calamities than most. We sometimes will do worse going in because we are concentrated and volatile, but not always. There was a period in the early 2000s when, and unfortunately this predates our GIPS verified track record, so you just have to trust me on it. But in 2000, 2001, 2002, there was a 3-year bear market that knocked the S&P down, I think 38%, NASDAQ down 60, 70%, something like that. And we had a cumulative gain over those 3 years. And when I say we, I mean the clients that became later the foundation of Mittleman Brothers. something around 20. And that was not atypical for value managers of that time. So if you had looked at the portfolios of David Dreaman or other value guys around that time, they were also making money in that 3-year period, which I think kicked off a 7-year period of immense outperformance for value strategies and for us in particular. So, it can work in bad markets. And it hasn't recently, which has been frustrating, but in bad markets, the kind of market circumstance that I see us in right now, to me, is more reminiscent of 1999, 2000 than any other moment in terms of the disparity between the popular and the unpopular. And we sit positioned as much we did in 99, 2000, which is away from the popular almost entirely, completely away from the popular, and very much deeply invested in these unpopular, out of the way names where we feel the cash flows will be there come hell or high water. And we think we'll be well served for that. There has seemed to be a change in sentiment, in flows back to value that began in November of last year. And so we have begun to outperform again after a long period of being underperforming by a substantial amount. And obviously, as a value-oriented manager, we hope that lasts. But it doesn't necessarily have to. You don't need a tailwind of value investing working to make money as a value investor. So everyone wants to kind of make things easy to categorize. Oh, that's value. That only works when value is working. We outperformed the market and we outperformed value managers in general for the first 5 years or so of the value bear market coming out of 2007. So that period from 2007 to 2012, when value was supposedly underperforming, we doubled our clients' money and the market was barely getting back to break even over those 5 years. So it's not, when you call yourself a value-oriented manager, yes, that's the culture that we are most commonly associated with and what we believe in. But it doesn't mean that one necessarily has to perform in line with the group. It seems like that's been the case recently, and I'm obviously happy that the group is coming back now. But I do want to make that distinction. When you are very concentrated in your investments, you can veer away from your own category if you're doing well or not doing well. So it works both ways. But yeah, I think that to sum it up in terms of our background, it is a background that was deliberately focused on cheapness as the one facet that we would not give up. In any investment, there's different facets to the diamond. You want to make sure that you've got good managers. You want to make sure you've got a good business, and you want to make sure you've got a good valuation. And some will compromise on these things to various degrees, and we will compromise as well. Sometimes we'll buy a super cheap business that we think is really good, but we don't have a great guy running it, and that may be the cause of the cheapness. Or sometimes we will take a mediocre business run by a really good guy at a great valuation, but we almost never, and I really think never compromise on valuation, because it's the one thing that we feel strongly about, that I feel strongly about, that we can, it's a part of the discipline that I think we really want to keep to, because what I've seen others veer away from that aspect of it, that's usually when people get into trouble. And so we really do stick to that fundamental aspect of value investing, which is that we are trying to hold the bat on our shoulder until the valuation is so cheap that we can't resist anymore. And that's a key part of the discipline.
Okay, thanks for that, Chris. One, I think, interesting thing to comment maybe is, going back to 2020, which was certainly difficult year for everyone. But I remember a piece you sent to investors. I think it was on the 11th of March, 2020. So in the moment of probably maximum noise in the markets, maximum panic. I think actually that was the day lockdowns started in Spain. And the title of your piece was something like "Why We Don't Panic," where you were stressing the importance of having the right temperament, the right process in place, and the right experience, right? So having gone through yourself through several of those kind of end of the world moments in your career, I I guess, helped tremendously to stick to your guns. But maybe you can comment on every crisis is different and every moment is different. So how you took it on a personal aspect. This one was certainly different to others, as we were all kind of at home, etc. So maybe you can comment on how you kind of reacted to that.
Sure. Yeah. I mean, I would compare it somewhat to 9/11 in a way because of the personal aspect of it. 9/11 obviously happened. A good portion of it happened in New York City, where I'm located. I was actually due to be at a meeting in one of the towers the next morning on September 12th on one of the upper floors, up above 100. So that was a 8-something, 9-something meeting that obviously never happened. But anyway, the aftermath of 9/11 was very depressing and very disconcerting. A lot of people thought that things would never be the same again. A lot of people were getting ready for a depression. I spent the days after 9/11, when the markets were shut down, just kind of assembling a list. I mean, I was obviously mourning for the people that we had lost and friends that I had lost in those buildings, but thinking of what I would buy when the market's open, because clearly there's going to be some stocks that are going to get knocked down a lot. And so I built up a list and I executed that list, and it worked out really well. So we made a lot of money coming out of 2001 9/11, despite the fact that there was still another year and change left in recession. And a lot of people thought that things would be bad for a very long time. So when I looked at the ramifications of a pandemic, I tried to think of it in historical perspective and what had happened in the past. And I was a little bit maybe too optimistic in terms of how quickly it would resolve, because I had looked at other pandemics and kind of noted the length of time it took for them to run their course. And most of them didn't take much more than a year to get over and done with. This one's lasted longer than the great Spanish flu, misnamed the Spanish flu, sorry, of 1918 to 1919. And I read the history on that. And so that encouraged me, because I felt, given the advances in medicine, and given how quickly things went back to normal. So this is a great thing you can do. Whenever you're worried about something, try to find a historical precedent and then go to that point in history and read everything you can read. So what I did, I went to the New York Times. They have this great thing on the New York Times, if you're a subscriber, where you can actually see the paper as it was back then. So you can go back to 1900 and see the paper and read it and flip through it. And so I did that, and I did it with some other periodicals. And what you see emerging after 1918 was things getting back to normal incredibly quickly. People going to theater again, going to plays. The pandemic dropped from the kind of national consciousness very quickly, and life came back very quickly. So that made me think, what, if they could rebound from that as quickly as they did back then, given the technology we have today, given everything is seemingly more advanced and better today, we should be able to do similarly. So that's all. Human nature, technology, the learnings that we had from that period of time made me feel that things would get back to normal more quickly. And so I did make a more concerted effort to communicate with the investors, as we always do in times of panic, why we shouldn't. And it worked out. I mean, obviously things got back. The stock market anticipated, as it usually does, that this would be a transitory event, and taking advantage of that moment of panic made sense. And it usually does. Usually, even the worst things that happen in stock market history are transitory. Not always. I mean, look, Russia shut down the stock market and never reopened it again in 1917 or whatever the year was. There have been markets that never recovered. So we don't want to be blithe about it. But really terrible things can be recouped in time. And so if you had invested, there's a great book that shows the investment history of the markets in war-torn countries like Germany or Japan after the wars, and you got back to even. Took a while, and I mean, you actually ended up making, if you had started investing as a 25-year-old right before the war in Germany or Japan, and you held, until you were 50, you actually made a very good return, despite seeing your investment go down 90% in the interim. So, I mean, when things shut down and everything was destroyed, most of those businesses survived. And the businesses that survived of the blue chip names in those countries ended up providing very good returns over time. So, it's I guess having a sense of history, having a sense of patience is what gives you the kind of intestinal fortitude to be able to ride these things out and to not overly extrapolate, because I think that's the undoing of the average investor, is that everybody extrapolates too much. They extrapolate success and failure, and that leads to wrong assumptions about the efficacy of an investment manager, for example. I mean, how many guys, when I started in this business, there were a lot of guys who were doing very well chasing technology and biotech in the early 90s who faded from public view because that it didn't last. There's a lot of guys that were very popular doing the same thing 10 years later that faded from view. So you've got to look beyond just the most recent 5 or even 10 years and look at the investment track record, over the longest time possible, and look at the discipline and decide for yourself whether or not you believe in that, whether or not that makes sense, and whether or not the person is doing what they said they would do. Because a lot of value funds, if you actually look beneath the surface, you'll see that it's not exactly, I think, what there's a subjective aspect to this, but I think a lot of value managers have kind of gotten away from value in order to survive, in order to do well. There's been this kind of subtle shift away from paying a low price to kind of buying growth at a reasonable price, and that's fine. There's nothing wrong with that. I'm not in any way saying that's bad or evil. It's whatever works, and so that's a viable strategy. What I'm saying is that for us, we've stuck to this kind of old school form of value investing, which I just find it suits my temperament, my my intellect, my kind of I guess my experience is in this, and not that I'm unwilling to change, but just that I find myself feeling more safe doing it this way, and more comfortable that the outcome will be there. So I'm less willing to pivot as many of my peers have done to pay up a bit when I feel that there will be value opportunities that fit with my discipline on an ongoing basis. And there have been. So, if I ever get to a point where I can't find anything to do and I'm sitting, with 80% in cash, then, maybe I'll start thinking about paying up for, growth opportunities. But we're looking to buy businesses that grow. Don't get me wrong. It's not like we want to buy things that are flatlining. We want to buy growing businesses. And for the most part, we do buy growing businesses. It's just that we buy them during periods when they haven't grown a lot recently, or they've gone negative for some reason. So, we are not, everybody wants to buy a growing business. It's where you buy it along its growth cycle that is important. And there invariably are periods of disappointment. I mean, you could have bought Amazon, after the collapse in 2001, 2002, it was down, I think, 80-90% from its high. I mean, that wouldn't have been a bad time. I thought about it, actually. I remember thinking about it and looking at it. But what scared me with Amazon, why I didn't do it back then, is simply that it hadn't generated any free cash flow up until that point. And the ambitions were so great. I had a hard time believing that a former hedge fund manager, Jeff Bezos, could do these things, to compete with Walmart, to build out this infrastructure. And the negative cash flow freaked me out, so I never did it. And obviously, that's an epic regret of a value investor. But we do find enough things to do to make the returns that are satisfying. And so I think that we will continue to operate with that discipline, despite the failings.
Mm-hmm. Maybe, Chris, you can comment on a specific investment case, a particular company that you're investing in now, just to illustrate your investment process a little more.
Sure. Well, I think it's good to focus on something that is really timely, because a lot of guys, when they're talking in kind of a more of a marketing mode, they want to kind of highlight what's working so it makes them look good. I like to talk about what's not working so that I could actually get other people involved so that when it does work out, then we all make more money. So yeah, we just started buying something recently that like many of our stocks, has gone down almost immediately. We bought a company in Australia called AMA Group. An AMA Group, we started buying, I think it was in Q1. And having watched it for a few years, so it wasn't like it was a new company to the investment library, but the stock had come down precipitously on things, on news that I thought was not fundamentally damaging. Their CEO was ousted, former CEO was ousted over a bit of a scandal. He was accused of overcompensating himself through unapproved expenses, and a few of his other co-workers who kind of came with him from a prior firm were also let go. So there was a management overhaul that left some concerned. That CEO had been a large shareholder, dumped all of his stock in the open market in a block trade, which was unnerving. We bought in around that time and have continued to buy and have made it a very large position for the firm, because the business that they're in is an easy to understand business, which generally generates not an amazing EBITDA margin, usually around a 10% EBITDA margin, but consistent free cash flow. And they're in the business of repairing cars. It's in different countries, it's referred to in different ways, but basically it's collision repair. And they call it panel repair. A car gets dent. You take it to one of these places, your insurance company will tell you basically where you can go. So your car has insurance. You get a dent. The insurance company will give you a list of options as to where you can get it repaired, where they will pay for it. And the insurers tend to be the biggest payers here. It's I think 90% of their revenues come from insurance companies. And in Australia, the insurance market is a bit more concentrated than it is in the US and other countries. So the insurance companies have a lot of power. This company, being the largest of its kind in Australia, with meaningful market share, I think they've got something on the order of 15% of the market. The market itself is I think $6 or $7 billion. They are not anywhere close to saturating the market in terms of their concentration, but they have grown through acquisition, and there's a lot more to do there. The vast majority of the market for collision repair is in mom and pop operators that are not as well capitalized as this company, and capitalization, having the ability to fund growth in this business going forward is going to be more and more important, because cars are becoming much more complex to repair, and there's a lot more electric, or I would say computer content in these cars. And so when you get a dent now, sometimes it's not just a dent. Sometimes you've got to recalibrate the sensors. From what I've heard, the amount of money that a repair company has to invest to be able to compete these days and be able to repair the cars that are coming more increasingly into their shops, something like $100,000 in equipment, in incremental equipment, to be able to do these things. And not every mom and pop operator is ready to do that or capable. So I think the ability to roll up the smaller players is going to be ongoing for years to come. And they're well into the lead there in Australia. There's no one that comes close in terms of their size. Anybody that's invested in this company right now, when you look at the top shareholders, they are all invested with an idea in mind. And the idea is that this company could be like a sort of a counterpart in Canada, which is Boyd Group. Boyd is the same kind of thing that we hope AMA will grow up to be. Boyd essentially rolled up the Canadian market for collision repair and started doing it in the United States as well, and has given their shareholders something like a 40% CAGR over the last 20 years or something like that. It's an outstanding total return. But basically doing the business, the same economics of the business apply in Canada and the US as they do in Australia. So the margins are very similar. I think Boyd probably has a bit of a higher EBITDA margin just because of the sheer scale of it now. But it's a very similar business. And when you look at Boyd, where it was some 15, 20 years ago, in terms of the size of it, is comparable to where AMA is today. AMA does not have a massive neighbor to the south that they can tap into to expand their market. So, I mean, Canada and Australia are similar in size. If Boyd was limited to just Canada, it probably wouldn't have been such a great story. But the point is that Australia is a big enough market, and AMA is small enough in terms of their market share at this moment where they can make meaningful inroads going forward by consolidation. So they've got about $1 billion in sales out of a market that's, $6 to $7 billion, I think is the estimate. They can double that sales number probably in the next 5 years through a combination of organic growth, but mainly through acquisitions. And the acquisitions are available at a very accretive price. So for the most part, unless you're buying a very big company in this field, you can pay, 3.5 times EBITDA for these small mom and pop operators. And you bring them in, you give them the benefit of the cost efficiencies of the larger organization. That EBITDA becomes more valuable in the market almost immediately. So, we've seen private equity firms, very smart private equity firms like Blackstone, Carlyle, some of the smaller names in private equity as well, buying these shops around the world and in the United States in particular. Most of these operations are private, but we can see where there is public debt issued, some of the numbers, and it's very similar, very, very similar. So I think that and also I should say that with AMA Group a few years ago, the way it got onto my radar screen was that I think it was in 2018, Blackstone had made an offer to buy the company or buy most of the company for what was then around 10 or 11 times EBITDA. So private equity knows these guys, that they're clearly of a size that has attracted interest before. So I wouldn't be surprised that something like that doesn't happen again. So we're not buying it just for the possibility of getting taken over, because we think that regardless, this thing should grow and we should make money off this valuation for years to come. But that would not be at all surprising given the opportunity that a smart private equity firm would be able to exploit here. So we've often said that we have a private equity mentality applied to public equity investing, and this is a perfect example of that. So out of favor for a couple of reasons that we think are transitory. I should also mention another thing is that beyond just the CEO shakeup, there's concerns in the market more recently, and this is why the stock has dropped since we bought it, of a supply chain disruption. So getting parts into Australia that they need to repair these cars has been problematic. Inflation, cost inflation, where they would have to absorb some of that up front has been a problem. Finding people to work for them has been a problem. Getting the staff back. So these are things that have plagued a lot of businesses in countries that are reopening. This industry in particular has seen its own version of that pain. But we think again that's transitory. So we don't think that the supply chain, the bottleneck is going to be there forever. We think that eventually, these parts will become more available, and they will be able to hire people as necessary. We don't think that margins go back to normal immediately, but again, we're not doing this for 5 to 6 months. We're doing this for a few years, and we think that we'll double our money at least over the next 2 or 3 years in this thing.
Okay, thanks so much, Chris, for that very, very interesting. I'm sure, Graham, that we have plenty of questions for Chris, so let's go ahead.
Alrighty, and we do have a question that came in right at the beginning here, Chris, that I'll go ahead and pass on to you from Tom out in the audience. When you do find a deeply undervalued asset, how do you determine if and when that asset will actually turn around?
Sure. Well, the timing of it is something that we actually don't spend, or I don't spend a huge amount of mental energy trying to figure out the timing, because what I found is that of all the things that I could spend time on, that's the most futile. It's just impossible to know. We've had situations where we bought a company in Canada. I think it was in March of 2012, Miranda Technologies, a television equipment production company. And I bought it thinking it was worth 17 or 18. It was 11, and it got bought out at 17 or 18 within a month or two. Now that doesn't happen every day. Sometimes you buy a company and you wait 5 to 10 years to get what you're looking for. So the timing of it is so unknowable that I don't spend a lot of time trying to guesstimate it out. We always hope for, and we think that, we're buying at the point of maximum pessimism, so that just the kind of reversion to the mean that you would expect off of a maximally pessimistic valuation would afford you a relatively near-term, period of reversion to the mean, and that should be, sooner than later, because generally speaking, if you're buying something that you think is extraordinarily undervalued and you really have waited patiently for that pitch, then you would hope that that would resolve within a reasonable time period, because usually extreme deviations from the norm don't persist at that extremity indefinitely unless some kind of new normal has been established. So that's the thinking. The catalyst, I guess, for us is the undervaluation, is what it comes down to. Not always. Sometimes we can identify and delineate, where we see, a series of potential catalysts on the horizon that, we can look for. And we can say, what, we have beyond just a cheap stock, we do have these great catalysts, but it's not a prerequisite for getting involved. So a lot of guys won't invest in value without discernible catalysts, but we will, because, we think that ultimately the valuation itself provides enough catalytic energy to make the thing go up. And that has been the case most of the time. I mean, not always quickly, but that has been the case most of the time.
Absolutely. And on that note of value, we've hit on cash flow a couple of times. Are there any specific metrics that at Mittleman you guys like to rely upon to really generate these kind of valuation statements?
Sure. I mean, it's always about free cash flow at the end of the day. So I think that every value manager at the end of the day is focused on that. Every rational investor, I think, is ultimately focused on that, whether you're growth or value. These kind of distinctions can be arbitrary and inane at the extreme. But the thing is that the free cash flow is not always obvious. So, sometimes you're buying a business that you believe, has a history of free cash flow generation, but there's no free cash flow visible today. And you have to be sure, or relatively sure, that it will come back. And so getting involved in a business that's going through a period of free cash flow reduction or even dipping into the negative is not uncommon for our type of investing. So you don't want to be so dogmatic and kind of rigid that you're like, oh, it doesn't have free cash flow today, so I'm not buying it. We think about things over the long term. We think over 5 or 10 years. Try to look at a business over a complete business cycle. So you want to see it. How does it do over a period where you have good times and bad times on display? What is it like in a recession? The things that we try to avoid during recessions are businesses that truly burn cash in a disturbing way. So, businesses where the good times are almost completely offset by the bad times, those kind of businesses we generally avoid. And so I'm talking about, heavy industrial names or airlines, things like that have generally been things that we have avoided. I'm not saying that we never would veer from that. I'm just saying that it's something that we try to avoid. But free cash flow is the primary determinant of value, I think, for most rational investors. And so that is kind of our guiding light, is how much cash. We try to imagine if we were to buy the stock today and we bought the whole business at that price, what would be the cash on cash return year 1, year 2, year 3, year 4, and how would that be relative to alternatives that we could invest in, risk-free alternatives, or high grade corporate credit opportunities, things like that. So that's it. It's a private equity mentality, I think. We don't always buy things that have leverage on the balance sheet. So the free cash flow that we're looking at can be unlevered free cash flow as often as it is levered free cash flow. But you do have to think about it. Another thing I should say is that in the things that we write and our communications with investors, we'll often put the valuation framework into more, kind of what is the corporate mandate of the day. So, for example, most analysts refer to price to EBITDA, enterprise value to EBITDA, price to earnings. We use that language because it makes it more easy to compare and contrast. And so while I recognize that EBITDA and adjusted EBITDA can be completely, managed and manipulated into almost anything, we will compare businesses within an industry on that metric so that we can kind of get a sense of, relatively speaking, is this a cheap company within that space? And so, we do pay attention to the way the industries themselves view themselves. So when you look at the buying and selling that goes on within a certain industry, take some instruction from the way that they themselves view valuation, because these are the guys doing the buying and selling. Strategic buyers are a huge part of the transaction, power here. And so if they feel that it's relevant to look at something based on recurring monthly revenues or, some metric that you wouldn't necessarily use with a different business, then pay attention to that. And so we incorporate that into our analysis to try to be, smart about each specific opportunity based on the specific metrics that are in that industry and what everyone kind of believes in that industry.
Definitely. And question here from WK, one of our usual viewers here. How, and I'll add in if we can, should we hedge inflation from an equity perspective?
Well, I think that equity investing is the hedge. That's the beauty of equity investing. It's the best hedge you're going to get. I think it's better than commodities over the long term. When you look at the way that, if you were investing wisely in equities, I don't think there's a better inflation hedge out there. A really good example. This is a great example. This is from, I think, that same book that I talked about, that was the history of markets going through like wars. The hyperinflation in the Weimar period in Germany. There was this period in time when the German currency of that moment, or I think it was from 1922 to 1932, something like that, was obliterated. Literally, it was reduced to nothing. And German bonds, if you were a bondholder in German, if you held German bonds let's say you were a U.S. citizen and you had invested your money in either the German currency or German bonds, you lost everything. But if you had invested in that 10-year period in a major German equity, the index, participants at that time, you actually made money. You made like 50% return over a period of time where almost everything else was destroyed and this is a US dollar investor. And, it's unimaginable, but the reason was that these companies were, generally speaking, earning money in foreign currency. So they were, making things and selling them to people that were paying them in hard currency, and they were retaining their value that way. So it's interesting. You can survive even in a hyperinflationary environment if you were invested in the right kind of company. Now, if you had only invested in a company that was making and selling things in Germany to Germans, it might have been a different story. So I'm not saying that that's you want to go and just willy-nilly buy into places like Zimbabwe or Argentina and local firms. You can get obviously severely damaged. But foreign currency earners in hyperinflationary environments can give you some kind of a respite from the ravages of hyperinflation even. So I think equity investing, that book, I remember the name of it, but it showed in graphic detail the US dollar return over the entire period of the Weimar inflation. And it was something like a 50% return to US investors, which is amazing. You would never think that would be possible, but that was in fact the case.
Absolutely. And question that we had just roll in here, would you say that you are sector and industry agnostic, or do you lean towards potentially areas of expertise and things like that?
Yeah, I think everybody kind of, you read a lot. And so as you read over time, you learn about different industries and you learn something new every year. I'm 53 now, and I'm learning things this year that I never knew before. About businesses that I barely understood before, or I thought that I understood, and I'm learning that I didn't. So it's an ongoing process, and that process begins and ends with the deliberation that you bring to it. Meaning that, when I started out in this business, I was reading to learn basic things, but also about different businesses that I knew nothing about and had no real interest in knowing about: forestry and, coal mining and steel scrap recycling and, biotechnology. Whatever it was, I tried to learn so that I could make informed decisions. And that's an ongoing process. So I don't reflexively exclude any potential business because of its sector. But I have avoided things like mining and airlines historically because of the unpredictability I feel and the difficulty that would bring for me. Maybe it requires being essentially kind of a one-man operation. I have a lot of support, don't get me wrong, but the investment decision-making process is much in my head, and my kind of library of resources and my Rolodex of contacts and those things. And so I just don't feel that I've developed the expertise necessarily to get more deep into those sectors, especially given that they seem more fraught with pitfalls if you're wrong. But that doesn't mean, again, that I wouldn't do something if I really felt that I was covered. And so I think that you want to be open-minded, but recognize that there are certain sectors and that tend to be more difficult to navigate. And so that's what I would say. I don't find myself necessarily leaning to one sector or another. Generally speaking, I do want to be open-minded. But I would say, just looking at the history of over 30 years, that I have tended to avoid mining and airlines and other things like automobile manufacturing. I've invested a lot in car rental companies and done really well with that. I've invested in, a lot of businesses that are ancillary to the businesses that I have not invested in. So, like airlines, for example, we haven't owned traditionally, but we've owned airline loyalty companies. So, it's an iterative process of learning about businesses and finding little opportunities in them. But yeah, so that's, sorry for the long-windedness. I just was going back on memory lane, and I probably veered too far from the question.
Absolutely, and no problem there. Well, at that point in time, that is going to round out the time that we do have for questions. For everybody out there in the audience, we do appreciate you showing up, especially those of you coming from our international audiences. It's been an absolute pleasure having y'all in our chat today, posting questions up for both Chris and Javier today. If you are interested in viewing things back, we do have a full recording available here on our YouTube channel as well as on Guru Focus, so do please feel free to take a peek there. Do like the video once it goes live here in just a moment, and subscribe to the channel if you do want to stay put for future content. For Chris and Javier, from us at Guru Focus, it's been an absolute pleasure having you on today. Thank you so much for taking the time to join us and answer these questions from our audience.
Thank you very much. Really
Thank you. My pleasure.
Thank you.
Absolutely. Well, to both you guys and our audience out there, we wish you the best and hope you have a good one moving forward.